It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
Welcome back, folks. I'm Larry Kudlow. This is the Larry Kudlow Show. By the way, you can get this radio broadcast on the internet, live streaming, LarryKudlowShow.com, LarryKudlowShow.com. And during the week, please join us on fabulous Fox Business Network. Name of the show is Kudlow. 4 to 5 p.m. every day, Monday through Friday, 4 to 5 p.m., Monday through Friday. If you can't make it at 4, why, just text your favorite 9-year-old, and she will show you how to DVR the show. And you'll never miss a thing. So let's look at the stock market, which was down for the week. Not much, 260 points on the Dow. Question is stocks versus bond yields. Bond yields have jumped up even while the Fed keeps pushing rates down. And inflation is still a threat, but earnings, profits are still very strong. Anyway, our two experts, Stephanie Link, Chief Investment Strategist at Hightower Advisors and Head of Investment Solutions, Jeff Kilburg, CEO of KKM Financial. So Kilburg's Notre Dame going to be the national champion?
We're on our way, Larry.
Yeah, boy, they look.
We're excited for the Fighters to get after it. Possibly get
losing you there. We need a better connection. You're sort of faded out. Go take your phone by the window or something.
That's high tech.
I was just going to say, Steph, that's the way I look at technology. Just go close to the window. You'll be okay. So.
Low floors and next to the window. Okay, good advice.
While Kilburg gets his act together, stocks are strong, profits are strong. I always follow Ed Yardeni and Ed Hyman, and they're both pretty darn optimistic. But there is an issue. You got a 10-year note that's at 4.60. Basically, the Fed cut interest rates by 100 basis points, and from that, the 10-year note went up 100 basis points. And some people are saying if the 10-year gets to 5%, that's a major red flag for stocks. I don't know what you're thinking, Steph.
I don't know. I think you said it. First and foremost, Happy New Year. Thank you for having me on.
Happy.
Yes, and I would just simply say, 5% yields certainly is competition for stocks. There's no question about it. And we have $7 trillion right now in money markets because of that, right? Because rates have gone higher. I think rates have gone higher is because growth has been better and inflation has been kind of stubborn at that 3% level. But all that being said, you said it at the beginning. It's all about profits. If profits are going higher, you taught me this 18 years ago. If profits are going higher, the stocks will follow. If profits go lower, stocks will follow. And so, what's important is that the economy is still strong. The Trump administration is inheriting a 3% kind of 2.5%, 3% GDP. I think it's a little bit harder to continue to see a 3 handle on GDP just because the fiscal stimulus is not going to be nearly what it was over the last several years. That being said, we know Trump is very pro-growth and lower taxes, deregulation. It's all going to lead to I think above-trend growth. Is that growth 2% instead of 3%? That's fine, because in a 2% GDP world, earnings can grow mid-single digits, as well as if you have margins that are going higher, which I am a firm believer of, and that we will see that. You can see upper single-digit earnings growth. That's pretty good, 8 to 10% in earnings. I think stocks would be okay. Are we going to be up another 23%? I doubt it if we're doing that kind of profit number. But I do think that there's still reasons to be involved in equities.
Well, I think, if you look at Trump policies, he wants a 15% corporate tax rate and 100% bonus depreciation on equipment and capital spending. Those are powerful stimulants. On the supply side, good for profits, good for real wages, and would probably calm down. There's still lingering Bidenflation, which is a bit of a problem. It's not like it was, but still, middle class is underwater. Blue-collar workers have lost take-home pay in real terms because of the cumulative inflation 20% plus 22%. But his policies are really designed for a stock market boom. There's no question about that. Without all the government spending, which is inflationary. In other words, Trump wants to do it on the supply side. Biden did it on the demand side. All right. The last year and a half, you've had better growth. But, of course, the price we paid was a very steep inflation rate. And that damaged a lot of people. So I agree. I'm looking, I think Ed Yardeni had something like 18% increase in profits, his estimate for this year, 18%. And that would, and I think he felt that the stock market. So if I round it up, call it 20% for the year, mostly from profits. You won't get it from interest rates. Is Kilburg back, or did he go by the window?
I'm back.
Right.
I'm back, and I have my Golden Dome helmet on. I'm ready.
All right, you got your Golden Dome helmet. So what do you think about the story here? Are you optimistic on the market?
Well, I'm cautiously optimistic. I think Steph brings up a lot of great points. To your point as well, there's a resiliency in the consumer that we just didn't expect in 2024. We're continuing to see the economy strength, but what's really kind of making me take a little bit of a cautious pause here is those interest rates. As you know, Larry, I manage portfolios of stocks now, but I cut my teeth in the bond market. Going back to the 90s at the Chicago Board of Trade, we always believed that the bond provided leadership. And what we're seeing right now, I think some of these pseudo bond vigilantes are waiting for a lot of this maturities to roll over, because if you think about the Fed and their swollen balance sheet, I know they're under $7 trillion now, and that's not really a pat on the back, but all that interest has to be rolled this year. So the interest, just to service the cost of our debt we've accumulated since the pandemic, that's going to be nearly $1.5 trillion. And I think the bond vigilantes want to be rewarded for that. So that's why I'm in the camp that 5% 10-year happens before a 4% 10-year, and there's a lag effect. As you know, we can't really correlate. Everything can't go up forever like it kind of has in some of these moments in the last 6 to 12 months. So I'm a little cautiously optimistic because I think we will see a little bit of rotation, but also a little apprehension with these higher interest rates having some teeth in January.
How much competition is that? I mean, I don't know that it's going to go to 5, but if it were to go to 5, how much competition is that, Jeff, for stocks?
I don't think it's competition, Larry. I think you're still the growth people are considering rebalancing, maybe repositioning and taking some of that exposure down. As we look at the top 10 stocks of the S&P 500, now at a historic high, near of the S&P 500 benchmark index. So I'm not going to say it's truly a competition. People are just getting apprehensive of if it gets above 5%. There's institutional stops in the market where people have to reposition their bond portfolios, and that can make a little bit of a fluctuation, spike the VIX. And that's where you may have a shallow opportunity to buy stocks on a 5 or 10% pullback. I think it's coming. Markets are not linear. We all know this. We've been around these markets long enough, but we have seen just a linear move in stocks and all asset classes. It seems like the other day, Bitcoin's become kind of the new proxy. As Bitcoin's up, stocks and equities are up. And that's a little concerning to this old 1990s bond trader.
Steph, you owning Bitcoin?
I do not own Bitcoin. I have in the past owned Coinbase because I think, if you're a believer and you want to own Bitcoin, that's great. To me, I just can't analyze the fundamentals of Bitcoin on a day-to-day basis, and it's so volatile. I can analyze the fundamentals of a company that's an exchange for the cryptocurrency, and it's also very diversified. So that's the way I would play it. That being said, the stock's up huge last year, so it's not something that I would dive right into today, but it certainly is on my watch list. By the way, back to the 5% 10-year, like if we get 5% in yields in general, last year. A year and a half ago when the Fed started the whole process of, 2 years ago when they started raising rates, and then the questions that I used to get from advisors was, oh my gosh, now there is alternatives out there. Not only because the last 10 years with zero interest rates, you didn't necessarily need to do anything other than be in equities. And so when the 5% came into play, all of a sudden, oh, wait a minute, maybe 60-40 isn't dead. Maybe 70-30 asset allocation isn't dead. And throw in private equity, you now have a lot of different choices. And so that, to me, is a 5% yield is competition. And that's one of the reasons why I cited earlier. That's one of the reasons we have $7 trillion in money markets.
Fair enough. But I will jump in because all advisors and their clients that I also support, they look in the rearview mirror. And yes, that is competition alternative at 5%, some private credit up to 10, 12%. But the S&P returned over 25% again. So therefore, that looking back, that hindsight view, we should have been more equity. And that's where I think there's vulnerability as you continue to see any allocation, any update in the markets, these passive index that go into the S&P 500 and buy the top 5, 6, 7 magnificent 7 names. That's where I think there's vulnerability. So I'm still on the growth story. We have just rebalanced down to an equal weight exposure in the portfolio I manage, the Essential 40. So that's where we get a little cautious going into the year because, when you see a micro strategy, which was seemingly leading the market yesterday, up nearly 15%, I don't know how you feel about MicroStrategy, but that seems a little bit of a Ponzi scheme to me. If we see Bitcoin go back under $60,000, what happens to all those debt holders inside of MicroStrategy? Is that potentially a black cloud on the horizon?
I wouldn't disagree, though.
I got to take a break. I just want to say I haven't rebalanced in over 40 years. Okay, not once. And by the way, I haven't owned a bond in over 40 years.
Well, you're picking up dinner next time, then, Larry.
I'm just saying, stocks in the long run. I am a believer in passive investing. I know lots of brilliant people disagree with that point of view, but the Kudlow Trust owns no bonds, all stocks, and it ain't going to change anytime soon. We got Stephanie Link, Hightower Advisors and Investment Solutions. We got Jeff Kilburg, CEO of Notre Dame. I'm Kudlow. We'll be right back.
This is the Larry Kudlow Show. Now, back to the Larry Kudlow Show.
Talking stocks with Stephanie Link, Chief Investment Strategist of Hightower Advisors and Head of Investment Solutions. Jeff Kilburg, CEO of KKM Financial and Notre Dame. So I got one for you, both of you. Talking to Dan Clifton earlier in this broadcast, Clifton, smart Washington watcher. Let's suppose that in the next few months, Mr. Trump makes some progress in stopping the Russian-Ukraine war, point number one. And point number two, makes some progress in the Middle East, closing down Iran and enhancing the outlook for the Abraham Accords, expanding into Saudi Arabia. Okay, Saudis would have come in if there had been a second Trump term immediately, but they didn't. But they're ready to move now. So you have a war premium on oil. If that war premium on oil, because of peace in Northern Europe and peace in the Middle East, oil could easily drop $20 from 70s to 50s. Gasoline, which has been coming down, will come down a lot more. That takes out inflation and interest rates, and stocks would roar, particularly if that's combined with a fiscal reconciliation package that contains a 15% corporate tax rate and 100% expensing. Okay, that is the ultimate bullish scenario. Oil prices come down because the war premium comes down and tax cuts come into play. Stephanie Link, let you take first whack. I'm just telling you, nobody. This is really the first time that I've heard a serious person talk about the war premium. It's not so much drilling for oil. Maybe that'll happen. I hope it happens. And Biden's doing so stupid things. A headline in the paper today wants to stop offshore drilling in the Atlantic Pacific. It's just the stupidest thing I've ever heard. And stop LNG exports. The stupidest thing I've ever heard. But Biden's going to disappear into the dustbin of history. But the point is, you could have a war premium reduction on oil prices, and that would be bullish as hell. Go ahead, Steph.
Well, sure, especially for the consumer, which is 75% of GDP. And it will also be very
business
positive
too. Business use energy. Businesses use energy.
Of course, but we all know we root for the consumer too, though, because the consumer is a very, very large part of this economy. But I think it would be very bullish for not only consumer but for housing. Mm-hmm. Housing is one of my favorite themes for 2025 because I do think rates are coming down, and we are 5 million homes short in this country, and we have underproduced for 14 consecutive years. Home builders would rather buy back their own stock than build out land, and they're not going to change that discipline anytime soon. I think it would also be positive for cyclical. So to your point, business investment, financials. Wait until you see the fees that we're going to see from the financial services industry, from capital markets, investment banking, wealth management, et cetera. But I also think if energy stocks come down, and because of the oil price possibly coming down, first and foremost, they mint cash at $35 a barrel. So even if you're at 50, down from 70, they're still printing free cash flow.
Yeah.
And they're also investing, and they're also returning that cash to shareholders. I think you buy energy into any weakness as a result. So I think you can have a much broader market if your scenario is right, or if Clifton's is right.
I think you buy everything, to tell you the truth. I mean, I just think you're talking about a boom, but it's not an inflationary boom. I mean, that Jeff, we forgot about the possibilities of, $45, $50 a barrel. And oil companies can make profits at that level. I mean, they've been making a lot of profit. I mean, they're like money managers now, but they make a lot of profits at 70. But they'll still be very well off. But I'm not worried about them so much. I'm thinking $2 gasoline, for example. I'm thinking about we need a lot of electricity, but the cost will be cheaper, provided that we crank up natural gas and nuclear. So what do you think of that, Jeff Kilburg?
Well, $2 a gallon from your lips to God's ears, Larry. But I'm going to take a little bit different, contrarian view, and I know you have a bigger brain than me, but just hear me out. If we actually see peace in the Middle East, which we all aspire for, and Trump may be able to bridge that peace, how do you rebuild the Middle East? How does the Gaza Strip get rebuilt? They're going to need money. How do they have all of their budgets in the Middle East predicated? They have off the price of oil up around $70, $80 a barrel. So there will be some reaction if we see a dip in energy, but I think that will be a buy.
You know who'll do it?
The sector dispersion.
Saudis.
2024.
The Saudis.
It was oil.
The Saudis will do it. The Saudis will rebuild. The Saudis will do it. And the Saudis will increase oil production, by the way. They've been holding it off. Anyway, we got to jump. Stephanie Link, thank you. Jeff Kilburg, thank you. Folks, Money in Politics coming up with John McIntyre and Steve Moore. I'm Kudlow. Lots more.